At one time or another, the majority of new options traders worry about getting assigned early on one of their stock option contracts. This is known as early assignment. And if the reaction to this is the following, you may be an idiot. But don't worry, of course, in this video, I'm going to show you the way a pro trader would also react to the situation so you can apply those changes the next time it happens to you. Let's take the example where you're selling a put or shorting a put and build from there. When you do this, you are taking on the risk of potentially having to buy 100 shares of stock at a predetermined price known as the strike price by a given expiration date. Early assignment is more likely to happen when an option strike price goes from out of the money to in the money. And when this happens, an example would be if you sold a put at the $100 strike, when the stock price was trading at about $120 per share. If that stock price dropped from 120 down below 100 and ended up at 90, your option contract with a strike of $100 would now be technically in the money. And there could be an increased risk or likelihood of getting assigned those shares of stock and having it done before the expiration date of that contract that you sold. This is worrisome because you may not have the money in your account to buy 100 shares of that stock, and you may not have been counting on doing so. So you have to either put more money into your account if you get assigned early, or it may be a bad company that you actually didn't want to ever own any stock of. You just sold the put in the first place or shorted it to get the premium by selling that contract. Or maybe you're in the third boat where you just don't know what happened. You were trying to buy a put when the market was about to go down. You did the wrong thing. I've been there myself. Many of my first trades, I fumbled through and decided to buy or sell when I should have done vice versa and had to close the trade at a loss as a result. But if you do this and you don't know what you're doing, you can be in a position where you're kind of worried about what's going to happen and could be in a place where you're getting assigned early. Now, an inexperienced trader may do the following. It would be very, very inadvisable to go and start to panic, number one, and think about walking away from stock investing altogether. Early assignment happens in some scenarios when the market moves unexpectedly. And if you don't understand what you're doing, you need to get educated first and cut down your potential risk factor of this happening. But the pro traders out there are going to do this instead. First off, they're going to look and say, hey, this is a company that I just got assigned shares of or potentially going to get assigned shares of early. Is this a company that I want to own long-term? If it is, you'd be okay owning the stock. Just take a moment, breathe. It's going to be okay. I promise you that. If it's a good quality company that you sold the put on, you shorted the put on, you're going to be okay long-term. Just sit back, relax, hold the stock, maybe take in some dividends along the way and wait for it to appreciate back up. The stock market has a history of recovering after big crashes. It just takes a little bit of time. The second option, if you have the 100 shares in your account, you can turn around and sell what's known as covered calls or sell call options on the same stock you were just assigned. So you get these shares in your account, and you can use them to generate more premium by selling covered calls on them and generating some cash flow in your account versus sitting it there with dead money, assuming the stock price hasn't gone down too low where selling calls is no longer lucrative. And the third option that most pro traders are going to analyze if this happens to them and they get assigned early, they're going to go ahead and say, I don't want this in my portfolio. I lost on this trade. That just happens. It works out that way sometimes. I'm going to sell those shares on the open market after I get assigned right away and take a small capital loss relative to freaking out, making a bad decision, maybe adding to a losing position, just letting my emotions take over. I'm going to sell now, take the loss, cut it off. Cut that head off the hydra. It's not coming back in this case. Let my portfolio recover, rest and breathe, journal my trades, make an entry, what happened, what went wrong, and come back to fight another day. The key thing here is not to get emotional in your trading at any time. This reduces your clarity and reduces the likelihood of you making good decisions with your trading. It is difficult to do, but as you go from beginner to intermediate to pro level trader, you'll understand that trading becomes more boring than anything, and you have your systems in place to understand what to do when you get things like early assignment thrown in your face. Sometimes you win the market, sometimes you lose. It's about staying in the game as long as you can, getting as many reps and kicks at the can as possible, and becoming more consistent and profitable with your trading over the long term. Thank you for watching this video. My name is Andrew Ferguson. Subscribe if you got some value here today, and I will catch you on the next one.